You guys ready to go? All right, we are recording this today. Welcome to the first 2021 Get Savvy, Grow Your Green Stuff webinar of this particular year, this particular semester. Today, we're going to be talking about tackling taxes. It's going to be very basic, and we will stress throughout this webinar that we cannot provide financial advice, specifically tax filing advice. You may have to contact a tax professional depending on your situation, but we will go over some of the basics, right? There are also a bunch of co-hosts monitoring the chat in case you have clarifying questions or you missed something, so we can get those questions answered. Don't hold on to a question until the end. Go ahead and put it in the chat if you have a question, and we'll be asking interactive questions for you to answer in chat throughout the webinar. So without any further ado, I'm going to talk about who's presenting today. So my name is Andrea Pellegrini. You've probably heard me on previous webinars. Today, I am more of a backup, and I helped with the slides, but I'm going to let Nikki and Kelsey talk a little bit about themselves.
Hi, everyone. I'm Kelsey Gerber. I'm an Associate Director of Financial Aid at Loyola University Chicago, and I handle all of the financial wellness, financial literacy programming there.
I'm Nikki Giancola-Shanks, and I work at the Illinois Department of Financial and Professional Regulation, better known as IDFPR, as the Director of External Affairs and Student Loan Policy. All right, so to get started, we have, as Andrea mentioned, we have a lot of people logging on today. So can you guys all please submit in the chat what state or country you're logging in from? Ooh. Lots of Illinois, but I see some Florida, Minnesota, DC, Texas, Canada. Nice. All right. So Andrea already mentioned this as well, but we just really want to stress the Get Savvy team. We're educators, we're not tax experts or accountants, so we're not going to be able to provide any sort of individual tax advice to you today or answer specific questions about a specific situation, but the presentation will cover basic key terms, items that you need to file, layout of a tax form, steps to file, etc. More the basics of taxes and how you can do it yourself and kind of understand a little bit more. So today's learning objectives, we want to define basic tax terms, especially because it gets real hard when you go to file if you don't know those. Discuss common tax forms and their uses. Kelsey will be walking through several forms today a little bit later on in the presentation. So you're going to hear me talk about some terms in the beginning, and then you'll see Kelsey put those terms to use on the form. Outline benefits of using pre-tax deductions, review the tax brackets and rates, and summarize resources you can use to file. All right, so to kick this off, we're going to start with tax terminology. So what do you think, which term describes your pay after taxes and deductions? Is it gross pay or net pay? You guys go ahead and answer in the, yeah, lots of, yep, everybody seems to be right. Your net pay is the term after. So we really want, there's a lot of different terms that are used to talk about pay and income when you go to file your taxes. So we want to start this presentation off by kind of defining those different terms to make sure it's all understandable. So your gross pay is what your one job says they pay you. So I'm going to use myself as an example. Because I am a public employee, you can look up my salary online. That's going to be my gross pay from the state of Illinois. Then they take your gross pay, you have your taxable benefits added in, minus the withholdings that your employer keeps, which we'll talk about, and deductions, and then your net pay. The net pay is what your paycheck from that one job is based off of. So it's what's your take-home money. When you go to sit down and do your budget, this is the money that you actually have. So in my example, what's listed on the website is going to be my gross pay, but that's going to be different than what my paycheck says. So now we're going to talk about gross income. And this is really where your gross income is the basis for filing for taxes. Your individual gross income is income from all jobs that you may have, all types of income. So this is especially for like gig workers, contract workers, gig workers, but if you have multiple jobs, you have side businesses, anything like that, your individual gross income is everything, all of those jobs together, what you make in a year. And that is the total before taxes. Then you have your adjusted gross income, which is better known as AGI a lot when people are talking about taxes. This takes your individual gross income and applies specific tax deductions. And again, Kelsey will walk through examples of these deductions. And then what you're left, or tax deductions, excuse me. And then what you're left with after applying all that is how much that number will determine how much income tax you owe for the year. So again, the difference between gross income and then gross pay refers more to just one particular job that you have, whereas gross income is talking about all your sources of money that you have coming in. Okay, so we are going to talk, I've mentioned these words a few times already. It does get confusing, I'm not going to lie, but Kelsey is going to walk through examples of both of these on the tax form, and that will help clear things up. But we just want to give you the differences and the definitions between these two words up front. So a credit, a tax credit, is money that's subtracted directly from your taxes owed. So you have that adjusted gross income, and a credit is then applied after that. So it reduces the actual amount of your taxes owed. So examples include the Earned Income Tax Credit, known as EITC. That one's talked about a lot. The Child and Dependent Care Tax Credit. So credits actually lower your taxes that are owed. Whereas deductions lowers your taxable income. So when you're figuring out your adjusted gross income, that's where those deductions are taken out. So you may hear things like itemized deductions or standard deductions. Again, Kelsey's going to show you examples and walk through this later, but that's applied to lower your taxable income. Some examples of these include charitable giving, healthcare costs. If you have a home office, job-related expenses, things like that is deducted. So the main point between credits and deductions is really where the money is being subtracted. Credits is directly from how much your taxes are owed, and deductions is lowers your taxable income. Again, Kelsey will have some examples to walk through. All right, so can you think of any examples of a tax exemption that you might be able to claim? Go ahead and write it in the chat box. Yep, I see some textbooks, disability, medical, kids. Education, Kelsey's going to get into education a lot later. Goodwill donations. Yep, all of those are different tax exemptions. So Andrew, can you thanks. All right, so tax exemptions are income or transactions that are free from tax. You don't have to pay tax on it at any level of government. So local, state, or federal. Most people will automatically think of charities, nonprofits, donations that you make there. Your dependents, we saw some people talk about kids. And another example is municipal bonds as well. There are lots of other examples, but those are probably the three that people think of the most. All right, so tax withholding. This is the amount of taxes your employer holds from your paycheck and sends to the government. So this is everybody who has on your probably your first day on the job, you have to fill out what's called a W-4. Again, Kelsey's going to walk through that so you can kind of understand the differences in the W-4. This is usually you have three choices on how much you want to withhold. And then depending on what you select, that's how much your employer takes out of your paycheck each time to give to the government. Those payments are then used as a tax credit when you file your taxes. So depending on how much you withhold, that means at the end of tax season, you may get a refund, or you may have to owe some more money to the government if enough wasn't taken out. Tax liability, this is what it's the fancy term for the taxes that you owe. So at all levels of government, federal, state, or local. Some examples include income tax, sales tax, that's all considered tax liabilities. There are lots of other examples, property taxes. I'm sure you guys can all think of different other tax liabilities, things that you pay taxes on to the government. All right, so what's the difference between tax liability and tax withholding? So your tax liability is your responsibility to pay your taxes. So that's money being, once a year you have to file, you pay your taxes once a year. Your tax withholding, that's your employer's responsibility. You fill out that W form, they withhold taxes from your paycheck, they have to turn that into the government. So if you don't estimate your tax liability, what you're going to owe, or you don't complete the W-4 correctly, you could either owe taxes or you could get a refund. It just depends on how those two things work together. So how much your tax liability is going to be how much you owe total. Tax withholding, how much your employer has taken out of your paycheck throughout the year. And then that gives you either a refund or having to owe. FICA. So FICA refers to the Federal Insurance Contributions Act. If you look at a pay stub, you will see FICA clearly labeled on it. This is what funds Social Security and Medicare. And the amount that is withheld from your paycheck depends on your gross pay. But it's something that everybody pays into, well, most people pay into, to fund Social Security and Medicare.
So I'm going to just jump in and briefly talk about how tax withholding specifically for FICA may differ depending on the type of employee you are. So for instance, at University of Illinois system, all regular employees, full-time employees and regular employees pay federal taxes and state taxes, but they only pay the Medicare portion of FICA. So withholding from the employer occurs for federal taxes, state taxes, and Medicare of FICA. If you are a student employee, withholding occurs for federal taxes, state taxes, but if you're enrolled in at least 6 credit hours or part-time, no FICA withholding occurs on your paycheck. So it might be that, let's say that you're enrolled 12 credit hours in spring and in fall, but in the summer you drop below to like 3 credit hours instead. If you're employed on campus during all those semesters, you might see a jump in how much in taxes is taken out over the summer months where you're not enrolled full-time. If you're a fellow, if you have a fellowship, even though your funding comes through your university sometimes, oftentimes in the case of University of Illinois fellows, no withholding occurs for federal, state, or FICA because fellowships are not considered employment. Therefore, no withholding occurs on them. That does not mean that you won't owe any taxes on that monies. It just means that there's no employer with a responsibility to withhold on. However, if you are an international student in any of these situations or a foreign national in any of these situations, it really depends on what your tax treaty is with your home country. So you'll need to contact your employing organization to kind of figure out which kind of tax withholding, tax liability situation you are in to make sure that you're estimating how much you owe accurately based on the information available about you. And every situation is different, which is why we can't provide financial or tax advice in the chat. So I just wanted to intervene there. And now I'm going to hand it over to talk about the tax timeline to Kelsey.
Hi, everyone. So I know Nikki kept saying, Kelsey's going to talk about that. Kelsey's going to talk about that. We're here. We're to my section where we're going to go over the timeline sort of chronologically, and then try to show you how everything sort of plays together and interacts. So hang in there. It might get a little confusing for a bit, but first you're hired at your job and you complete a W-4. So if you are a paid employee of that company, this is how you'll show them, how much to withhold or help them estimate how much to withhold from your paycheck. And we'll have an example of that coming up. You'll then choose any pre-tax deductions. We'll have examples of those as well. And that can reduce your taxable income. Then once a year, you get your W-2 from that employer showing what you were paid, how much was already withheld, and you can use that to calculate your taxes. You might also get 1099s. I should mention if you're a contract worker or self-employed, you won't receive a W-2. You might have a 1099. Also, we'll talk about different 1099 forms, but there are other forms tied to other accounts that you might have that are forms of income. And then you file. So this is where you sit down, you put on the fun music, and just brace yourself for the fun of taxes. So our next slide, this is an example of part of a W-4. It can get pretty complicated, especially if you have multiple jobs or your spouse is working, particularly if your spouse works and you have vastly different incomes. So you can see that step 2, letter A has an estimator at the IRS. I would recommend going through that, but then the main thing I want to stress here is you fill this out and then you get your first pay stub. Look at that pay stub and use what you've learned today or will learn today to sort of hand calculate or use that IRS estimator again and make sure that it looks like you're on track, because you can make adjustments to that and send another W-4 to your employer and ask them to make updates if you notice that maybe it's a little off. So I mentioned pre-tax deductions. So those are things like certain retirement plans that you might have through your employer. The portion that you're contributing might come out before taxes, so reducing the amount you're taxed. Life insurance, health insurance, FSAs, and HSAs, those are funds set aside to pay for medical expenses. And then transportation programs. So if you're in Chicago, for example, I have a pass for the venture pass for the CTA, and that comes out of my paycheck pre-tax, so it saves me a little money. So I want to illustrate on this next slide how this helps. So we've got Bob and Joe, and they have the exact same expenses for their healthcare. They've got dependents that they're paying childcare for. They've got some commuter costs. And Bob is not having those go through his employer. He's just paying for those after he gets his paycheck, whereas Joe is using those as pre-tax deductions. And so you can see the difference at the end is it reduces Joe's taxable income by $4,160. So that's how that ends up saving you money, is the amount that we're then taking deductions from and credits. It reduces that from the get-go. So if you're going to have those expenses anyway, this is a great way to reduce your taxable income. So next we have this W-2. Again, this is if you are a paid employee of a company. So be careful if you work for companies that come to mind are like Uber and Lyft, Grubhub, deliveries, things like that. You might technically be a contract worker, and that can be very different and is a good reason to work with a tax professional because you have to withhold your own taxes and potentially estimate and pay those quarterly, and it can be very, very different. So we want to focus on if you are a paid employee at a company and you get your W-2, they have to get this in the mail or sent electronically to you by February 1st each year. So those should be coming out soon for 2020. So you can get those taxes filed. It'll show what you earned and then how much was already withheld. And then you use those on your 1040 when you file to figure out if you still owe more or are due a refund. So then we sit down. Again, we crank up that music. I was joking that normally I might blast a little Tay-Tay, but her last two albums have been kind of chill and not really conducive to getting excited about taxes. So leaning towards maybe some Dua Lipa or dance music this year. I'd love to see people's suggestions in the chat. I can look at those later if you got some good party music for me. But yeah, so you really want to make sure you have all your identification info and the sources of income. So make sure you know your social security number, your date of birth, have your W-2s, any of those 1099 forms that we mentioned. I really want to call out, and this is why it's in bold, that if you did not have quote unquote income for the year, but you were unemployed and received unemployment, that is income. So you'll have a 1099-G where you can report that. You do want to make sure that you're looking at that. We'll talk a little bit later about how taxes work for things like that and why it's important to really track decisions you make throughout the year and be aware of those, and then really look at these forms. So lots of different 1099s you might receive. The middle column is some examples of home, healthcare, childcare, things that might be used on your taxes to save you some money, and then education. So we'll talk more about education specifically and how that works with your taxes. So next,
I just wanted to,
oh yeah,
Kelsey, when you're pulling together all the identification info, you'll need social security numbers and dates of birth for any of your dependents or your spouse if you're going to be filing for your family as well, not just your own.
Yes, that's a good point. And when you're filing online, in order to make sure that it's you, sometimes they'll ask what your adjusted gross income was last year. So you might even want your taxes from last year handy if you're using a different software or a different provider than you used the prior year. So go ahead and find those while you're at it too. All right, so based on that, and I know there was a a question sort of related to this in the chat. What do we think? Does everyone have to file taxes? Seeing a lot of no's. More no's. If you owe, yes. Okay, so yeah, it seems like we're all pretty much in agreement. So you are not required to file if all of these apply. If you are under the age of 65, you would file as single, so you're not married or don't have dependents. You earned less than the standard deduction for the year, which for 2020 is $12,400. We'll talk more about what that means later. And no special circumstances where you're self-employed or you had certain types of income that maybe require you to file. If you just have a standard job with a W-2 and your earnings are less than $12,400, you fall into this. And then if you are not claimed as a dependent by someone else. And again, I keep saying this, but we'll talk about that in a future slide about what that means as a dependent. So the next slide has, I know I mentioned the $12,400 if you're single and under 65. You'll have access to these slides later, so don't feel like you have to memorize this by any means. But for 2020, these are the thresholds for if your income is over this, then you are required to file. And I just want to say that yes, that $5 for married filing separately is correct. It is not a typo. This is to prevent people from really working the system in some cases and trying to hide income. And so if you are filing married but separately, then you have to both file if you made more than $5, each of you. So now we'll get to that dependent question. So if you are under the age of 19, or if you're a student that's attending at least part-time and you're under the age of 24, you are likely going to be claimed as a dependent if you're getting the majority of your support from someone like your parents. And then there's no age limit if you are permanently and totally disabled and are receiving your support from a parent or a family member or someone else, then there's no age limit for that. So based on that, do you think you should file your taxes if you're claimed as a dependent? I see a no, 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 yes. Yes, if I worked and paid in. No, depends. Okay, I like that there's some different answers here because that shows that this is something we need to cover. There's some confusion there. So on this next slide, we'll give you an example of why you might want to file. So first, I want to say that if you are claimed as a dependent by someone on their taxes, like say your parents, then you can still file your own taxes. You just will put 0 for the exemptions and you won't claim yourself. So earlier when we talked about exemptions, someone else is claiming you, so you won't claim yourself, but this is a way to maybe get back some of that money that you paid. So in this example, if you made $2,500 in gross earnings and your employer withheld $300 over the course of the year, that's less than the standard deduction as a single person under 65. And so you are owed that full money back, that $300. So in order to get that money back, that would be a reason to file your taxes, even if you're claimed by someone else. So next, we're going to dig into the 1040. Really, the takeaways here are the first page deals with different types of income and deductions from that can reduce the amount that you're actually taxed on, so that we end up with that adjusted gross income. And then later we'll cover the second page that's more about taxes and credits. So on this first page, I do want to, yep, thank you. I'm going to point out that line 1, that's your W-2 net income that's going to show up on there. 2 through 7, that's where you might have a 1099 that goes there. Schedule 1 is where education credits might go, or education deductions, I should say, might go, along with some other things we'll cover. New for 2020, as part of the CARES Act, typically it doesn't matter if you donated to a charity. unless you donated so much and you've got so many other qualifying expenses that you can itemize your taxes, which we'll talk about. But this year, even if you're taking the standard deduction, you can report up to $300 in charitable contributions and reduce your taxable income. So that's not going to affect it a ton, but got to save where you can save. So another thing I want to point out is 10A, that would be unemployment. That's where your 1099 goes. And this is what I was talking about earlier, is you can either choose to have tax withheld from your unemployment when you are signing up for it, or some people opt out of that. And so this is where you're going to remember whether or not you did that, as you might owe taxes on that now if you weren't having that withheld before. And then line 12 is that standard or itemized deduction. So let's get a little bit more into some of these. So Schedule 1, here are some examples of things that would go on that line. So self-employment expenses, if you are a self-employed person, have your own business, educator expenses. You might have heard of people writing off their home office space, that falls in here. Health insurance. If you are self-employed or you're a contract worker where you are paying full FICA taxes, typically you pay half and your employer pays the other half. But if you fall into a situation where you're paying the full amount during the year, then this is where you can get that half back. Retirement savings, we'll talk a lot about tuition and fee expenses and student loan interest paid, because I know people have a lot of questions about the education portion. Retirement things, HSA, if you have property that you own that you earn income on, but you have some expenses related to keeping that property up and running and in a good enough situation that you can rent that out, those go there. And then Olympic medals. So if anyone has an Olympic medal, that's where that goes. So the next slide is the education deduction specifically. So the 1099 will be generated from your school if you had paid qualifying expenses. So you might get a 1098-T and then not qualify for this, but that's how you can use that form to figure out if you do qualify. It also is paid expenses within a calendar year, so sometimes that can get tricky. So if you have questions, definitely reach out to your school and whichever office handles that to ask them why you did or didn't get a form and help them or have them help you explain what all of that means on there. But if you get the form, you could potentially have the tuition and fee deductions and claim up to $4,000 of qualified tuition and fees as an adjustment to your income. So it goes on that first page and reduces your taxable income. It reduces that AGI. You can't claim this if you're married filing separately or if you're claimed as a dependent. So this would be if you are on your own claiming yourself, and then it gets phased out for higher income taxpayers. So that's why it's there's potential that you could get the form, but then not be able to claim this. Student loan interest deduction. If you're paying on your student loans, you'll get a 1098-E for interest that you've paid over the year if it's more than $600. They won't automatically send you one. Depends on the loan servicer, but they might not send you one if it's less than $600, but just know that you can go in and find that information yourself and then still use that for your taxes. You can deduct up to $2,400 of interest that you've paid over the year. And again, that gets phased out for higher income taxpayers. So those are two ways that education deductions can reduce your taxable income. So then we get down to the standard versus itemized deductions. So I would say the majority of people probably take the standard, particularly if you are a paid employee with a W-2. Gets a little trickier when you're self-employed or a contract worker. It's much easier to itemize, but standard is on the left in the chart there. You can see the amount that you just get without having to do anything else. If you have itemized deductions over that, then you can itemize. If it's less, there's no reason to itemize because the standard deduction is better for you. That was my cat, sorry. So examples would be medical and dental expenses over 7.5% of your AGI, mortgage interest deductions, charitable contributions, state and local taxes, and then losses from a federally declared disaster. Those are some examples of if all of that adds up to more than the standard deduction, then you might want to itemize. So then if you can kind of picture that 1040 in your head again, you have your income from all the different sources, and then any deductions, maybe you have some education deductions. Then let's say you take the standard deduction, then you end up with a number that goes through these tax brackets. And the tax brackets get a little confusing. So I wanted to really break this down and give you an actual example of how this works. Because a lot of times people will say, well, I don't want to get a raise that puts me into the next tax bracket because I'm taxed so much more that it doesn't even make sense to get the raise. And it's like, well, no, that's not how that works. So in this example, this person is filing head of household. So let's say maybe it's a single parent with some children, and they are filing head of household. So you start with your gross salary. This is what they're just offered for the job. This is on their offer letter, $50,000. And then they had some retirement contributions. They put some money aside for childcare. They contributed towards a medical account, and that reduced their net income to $46,100. So that's what will show up as like the taxable amount. And then they're taking that standard deduction that's a little bit higher for head of household compared to single. And then what's left is their AGI, the $27,450. So from that, then you take it through these tax brackets. So the first $14,100 is taxed at 10%. And then the difference between the amount that they made, the $27,450, and then the $14,101 that you can see there, that's taxed at 12%. So it just, each amount in those brackets gets taxed at that percent. It's not your entire income. So I know that gets a little tricky, but if you can kind of understand how this works, it's helpful to look at your pay stub and go through that IRS estimator and make sure that you're withholding enough that it'll all work out the right way in the end. So now we get to page 2 of the 1040, and this is where you can see different credits that will, as Nikki mentioned, that reduces the amount of tax you pay, not just the taxable income. So we're past all the brackets now. They say, here's how much you owe in taxes. Here's some ways to reduce what you actually owe. And I just want to call out line 30 there at the bottom. That's the stimulus line from the CARES Act and many other acts. So I want to just make sure we're clear. The stimulus money was free money. It does not need to be repaid. So if you already received that money, great, I hope it helped. And you don't have to care about that on your taxes. This line is there for people who were eligible and did not receive it. I know there were lots of issues with the second payment, with it not going to people's accounts correctly or the checks not getting to them. So if for some reason you didn't get the money and you were owed that, this is where you can add that as a credit. So maybe you were already going to get a tax refund. Now it's going to be increased by the amount of the stimulus money that you should have received. So hopefully that kind of helps clear that up a bit. I know there's a lot of confusion around that. So we can talk a little bit about education credits as well. That's another schedule, Schedule 3. You can take one or the other of these potentially, not both. And if you're claimed as a dependent by someone else, you cannot take these. So again, this is if you're on your own. The first one, American Opportunity Tax Credit, it's up to $100 in the first $2,000 of expenses. And that can actually include course materials like books and supplies and computer equipment. And then $25,000 for the next $2,000 up to the maximum. So maximum of $2,500 per eligible student. Again, not if you're claimed as a dependent. You have to be at least enrolled at least part-time or half-time. And it's just for the first 4 years of your undergraduate degree. So if you're staying on an extra year or you're a graduate student, this would not apply to you. The great thing about this is it's partially refundable up to $1,000. So if it reduces the amount of taxes you owe, and then there's still, say, $500 left over from it, you can actually get that money paid to you. So that's not the way with a lot of these, but that's one benefit to this. Again, it's phased out for higher income taxpayers, just like the education deductions were. The other option is this lifetime learning credit. And this is open to people who are enrolled less than part-time or are graduate students. So this is a better option for students that fall into those categories. And it's a credit up to 20% of the first $10,000 of expenses, or a maximum of $2,000 per return. So it does max out at $2,000, and no portion can be refundable. So maybe you were going to owe $1,500 in taxes and you have this $2,000 credit. You don't get a refund of that extra $500. It just takes your taxes down to zero. So it's still better than nothing. Obviously now you don't owe any taxes, but it's not refundable like the American Opportunity Tax Credit. I know that gets very complicated, so I know there's lots of links in the chat and you can read up on that more, but we also just briefly want to talk on the next slide about education programs that also have tax benefits, because we get a lot of questions about this. One example you've probably heard of is a 529 plan, it's qualified tuition plan. This is great because your money is growing tax-free, and as long as it's taken out and used for qualified education expenses, those distributions are not taxed. And then most states, if you are contributing to their state plan, there's no state income taxes on the amount that you're contributing. So it really can help save in a lot of ways on your taxes. For this one, there's no income or contribution limits versus before 529s really took off, there were the Coverdell education savings accounts, and they had limits to how much you could contribute, and there were some income limits. So Bright Start is the name of the one in Illinois, and you do get breaks on state income taxes if you contribute. So I want to plug the Making Sense of Money podcast that'll come out in early February that'll talk more about this. So look for that link in the chat and the resources available later. Okay, so now that our brains are just total mush trying to absorb all of that, what do you think is better, a $500 tax credit or a tax deduction? Credit. Okay, so it looks like we're pretty much in agreement that it's credit. We'll show you a very, very simplified illustration. So this is typically not how it works, but just so you can kind of wrap your head around this, let's pretend like with these amounts, they both took standard deduction that's already like removed. The first one with using a deduction, if the income was $9,950 and the deduction of $500 is removed, then your adjusted gross income is $9,450. That falls into that first tax bracket of 10%. So you owe $945 in taxes. There's no credits removed from that, so that's what you pay. With a tax credit, they didn't have any extra deduction, so the AGI is still $9,950. It falls into that 10% tax bracket, so that's $995, and then they get a credit that is removed directly from the amount they owe, so they only owe $495. So again, this is very simplified, but it does illustrate how a lot of times credits can be better than deductions. So hopefully that kind of helps explain those 2 pages of the 1040 and how it all sort of works together.
But you can use both.
Yes, absolutely. You can have both. You could have an education deduction, potentially a credit. You can definitely utilize things from both categories to try to reduce your taxes as much as possible, like we want to do. So I'm going to turn it back over to Nikki, and we'll talk about Okay, now we know kind of what this is going to look like. How do we do it?
All right, so I'm going to go ahead and talk about some tax filing resources. The first, so these are, Andrea, can you go back a slide? Thanks. So how to file, there's kind of three different main ways that you could file. The first is the do-it-yourself model, which is called Free File. The website is at the bottom of the slide on the IRS website. This is if your taxes are fairly straightforward, you don't have a ton of different questions, this is definitely a good option for you. Then there's also software, like I'm sure you've heard of TurboTax and H&R Block and things like that. So those software programs do have a fee associated with them, but they're smaller fees compared to, then your last option is a tax prep service or accountant. So that's somebody that you're actually paying to file your taxes for you. So you would get all your paperwork together, they would fill out all the forms for you. So that's kind of, this is the scale of free file to like most expensive options on how to file. So there are different organizations that offer some free tax help. The first that we're going to talk about is called VITA. It's the IRS Volunteer Income Tax Assistance. The locations of these and limitations vary. So you could go to this website and look up and see if you qualify to receive the VITA services. A lot of it has to do with, a lot of it has to do with income levels and things like that, but that's a source to check. United Way, My Free Taxes. This is for taxpayers that earn less than $66,000 a year. So the threshold for VITA is going to be less than 66,000. So if you make a little bit more, that doesn't qualify you for VITA, we would suggest looking into United Way. And then there's also Ladder Up. This is this year, they're doing some virtual tax assistant programs. In years past, I know they've also met with people in person, but I think because of COVID, they're kind of changing it up a little bit. And those have individuals earning up to 30,000, couples up to 57,000 per year. Another resource that I want to talk about is getmypaymentil.org. I know Kendra dropped it in the links. This is a website that you could go to if you have questions about the stimulus checks that we talked about and taxes, and how if you never received your stimulus check, you need tax help now. This is going to be a resource that's pretty much, it's free, and the information is going to be tailored to the stimulus checks and taxes. And just to reiterate again, because I know we had some questions in the chat when Kelsey was talking about it, that is free money. You do not owe taxes on, if you received your check, you do not owe taxes on that check. It's just free money. All right. We also want to highlight this webinar that Get Savvy put on. If you decide that you do need some additional tax help and you're willing to pay for it, this webinar talks about how to choose a financial pro, what to look for, how to not get, making sure that you're paying somebody who's legit for what you need. All right, so important dates that we want to go over for this year. So February 1st, as Kelsey mentioned, that's the deadline for your employers to provide W-2 forms, and universities and colleges to provide 1098-T forms. Some of you guys may be able to download your W-2s electronically, and if you can, that's great. They still need to get you that link or that information by February 1st. For those of you like me who get them in the mail, it's just important to remember that your employer has until February 1st to put it in the mail. And since the mail has been little slow, you may not actually receive it until like the second week in February. If it gets to be, you know, the end of that second week and you still don't have anything, definitely check in with your employers. Then February 12th is when the IRS actually begins accepting and processing 2020 tax year returns. So for people who want to file early, you could start doing that as early as February 12th. If you file early, that also means if you're due for a refund, you will get your refund quicker. That does not mean, however, if you owe taxes, that you're going to owe whatever day you file. April 15th is the big date. That's the deadline to file your tax returns. Or if you want to file for a tax extension, you have to do so by April 15th. And that's also the same for paying taxes that you owe. If you choose to ask for an extension, then the next deadline is October 15th for to file taxes. So we wanted to touch a little bit just for things to be careful of, particularly with COVID scams and identity theft and things like that have been running rampant. So things to keep in mind: make sure you're protecting your information. You know, don't just give away a social security number to anybody who calls, or make sure your passwords, if you're logging into the IRS, make sure your password is really strong. That basic kind of internet safety is gonna pay off. Scams, especially via the phone and online. So 2 things to keep in mind is that the IRS will never initiate contact with you by email, text, or social media, ever. So if you all of a sudden get an email that claims that they're from the IRS and something's wrong with your tax form, or what they need more information from you, it's automatically a scam. That is not how the IRS will contact you. They will also never ask for your PIN, and your PIN number is, once you create an account on IRS, that's like, you know, your identification number, they will never ask for it. Not on the phone, even. Like, they just will not. So if you're on the phone with somebody who claims they're from IRS and they're asking for your PIN number, hang up. And just, if you think that your identity has been stolen, visit identitytheft.gov, and it will kind of walk you through different options that you have to rectify that situation. So in summary, kind of in order, complete your W-4 accurately and feel free to update it if needed. People don't realize that they could update that. Make sure you're comparing your pros and cons of pre-tax deductions. Keep all your tax documents safe. So it's very tempting. I view this as 2 ways. It's very tempting that you get these papers and things in the mail and you're like, oh, I don't need that. And you toss them or shred them or do whatever. Keep them until you make sure you don't actually need them. And also protecting your online identity as well. File early and for free if you can. Again, the earlier you file, the faster you're going to be able to either get that refund or know how much you have to owe, and then you are able to figure that out before that April 15th deadline. And beware of scams and watch for tax identity theft. So that's it for taxes. We know we threw a lot of information at you. Links and the presentation, everything will be emailed to everybody who was here today, so you could kind of go through at your own pace and look at all the resources. But just to plug our next one, on Wednesday, February 24th at 12 p.m. and the topic will be Save on Food. So if there are any questions, go ahead.
I think I saw a question earlier about paid internships and whether or not you need to file if you have a paid internship. Typically, at least with the internships, the paid internships that I run, you are an employee. However, some institutions may make you a contract employee, so they may give you a 1099 for that paid internship instead of a W-2. All of my interns that are paid end up with a W-2. Kelsey or Nikki, do you have anything to add for that question?
Yeah, I'll jump in. That's income. So one way or another, taxes are being paid on that. Again, if it's low enough that you don't have to pay those taxes, but they were withheld, then you can file to get the potential refund. But that is a form of income. So I would look at the pay stub and see if taxes are being withheld to kind of plan ahead.
There is also another question from a graduate student asking about, can they get the standard deduction if they get education deduction and the learning lifetime credit?
Sorry, what? Okay, can you get the standard deduction if?
So can they use the education deduction and the lifetime learning credit and the standard deduction?
Yes. So you can have any deductions that you qualify for as long as it's not one of those situations where it's, you know, one or the other for education. You can have any of those deductions, then the standard deduction. And then on that next page, you could potentially have credits removed from the taxes owed. So yes, you can have all of those things.
So I've also seen a question about, and Kelsey, you kind of covered this, but maybe you could talk a little bit more about it, about dependent and independent status, that a lot of students want to claim themselves as independent, but it's a tricky situation with financial aid and things like that. So maybe just highlighting the difference between those two again, real quick.
Yeah, so that's a good thing to bring up, is that for like FAFSA purposes, if you're filing to get financial aid, they don't care what your taxes look like. They're separate rules. So until you're 24, married, have children, any of those dependency questions on the FAFSA, you are considered dependent and have to include parent information. Even if you feel that you're self-supporting, you file your own taxes, unless there are certain situations where you can work with the financial aid office and appeal. So if it's like an abusive situation where you can't have contact with your parents or you have no idea where they are, there are things like that. But generally for FAFSA, you are a dependent until you're 24 or grad student married children. So it's different with the taxes, and you do have to work that out with your parents and whether or not they want to claim you or not, and decide, you know, what's best for everyone.
That might be a difficult conversation to have, since
Yes.
I know working with some students, they're not on the best terms with their parents, but their parents are still claiming them as a dependent, even though the student is paying for all of their living expenses or education expenses by themselves. And that is not something we can necessarily help you with, unfortunately. It's one of those problems.
Yes. And speaking from experience, a little different than that, but in my prior marriage, we should have filed married jointly together, because then I could have received all kinds of education benefits because I was in grad school. But he went ahead and filed separately before I had a chance to say, hey, this is more beneficial for both of us to file together, and then would not amend. And so I owed taxes instead of getting a refund. So nothing you can do about that situation. You have to all be in agreement on how taxes are going to be filed. So yeah, it's not a great situation sometimes, but is what it is.
There's
And-
another, go ahead. Go ahead.
Well, I was just gonna, do payments for a dependent student loan interest count toward a credit? And Kelsey, this was I know you kind of addressed this, but yes, your student loan interest does count as a credit.
Yeah, if the question is if you're dependent, if you made payments for your dependent, I believe it's only the person whose name the loan is in can claim those credits, but that's, again, I'm not a tax professional. So you would want to check with a tax professional or an accountant, but with your own loans and your own taxes, you can claim that interest payment for sure. But outside of that, it gets a little trickier.
So there is a question about international income. So do you report income you earned outside of the US? For instance, if you are a US citizen but lived and worked abroad for a foreign company and paid taxes in that country for part of the year, do you have to report that?
Probably. I don't want to touch that one, Nikki.
Yeah, I was going to say that's definitely one that I would ask a tax professional about, because there could be all sorts of, it depends what you were working on and what you were doing. And, so that's kind of one of those more individualized questions that I feel like talking to a tax professional would probably be the most beneficial for you.
Exactly.
And I think from the opposite perspective, we have international students that are here that worked at home, but have also worked here. Their tax treaties will dictate who they have to pay and where they have to file. They may have to file both places. There might be resources available through an employer or through their higher education institution to help them file in both places. But make sure that you meet the deadlines for whatever countries you're filing in. You might have to file in multiple places. I know with people that have they've lived in multiple states and the state level taxes are different. Some people have to hire multiple tax professionals to work together in order to get all their tax questions answered for those different states within the United States. So that's a non-answer to that question, other than it's complicated, ask a tax professional.
Yeah, even if you live in one state and work in the other, you might pay state taxes in both. And so anything like that, you definitely want to get some assistance.
Great question. Do I have to file for previous work experiences or just for that year? It's just for that year. So for the deadlines in 2021, you're just including your jobs from the year of 2020. And I see a question about the American Opportunity Credit. And I'm not quite sure I'm understanding the question. If studentaid.gov doesn't care about your taxes and how you have been claimed, students could not be claimed and get the American Opportunity Credit. I'm not quite clear on that. That's probably something you would also want to talk to a tax professional, unless Kelsey, you know.
I mean, the main thing is that studentaid.gov FAFSA is completely separate from taxes. So regardless of how you file your taxes, whether you're claiming yourself and doing your own, or you're claimed as a dependent, unless you are 24, married, have a child, grad student, any of those things that would make you independent on the FAFSA, you are dependent with parent information on the FAFSA. So they're just two very different situations.
I think where it gets confusing probably is the fact that the FAFSA uses income information from your taxes. And that's where it can get confusing. Well, do all these definitions apply to my tax identity and my FAFSA identity? The answer is no, like Kelsey just said.
Yep. So definitely when you have questions about FAFSA specifically, talk to your financial aid office and they can help you sort through that.
Absolutely. Or if you are in Illinois, the Illinois Student Assistance Commission can also help. All right, we had some great questions in the chat.
Hopefully we got to them all. If we missed any, we apologize. But again, the presentation and all the resources and things that were being thrown out in the chat, you will definitely be able to, you'll be emailed them and can look at your leisure